Well, good afternoon, everyone. My name is Rob Holcomb, and I'm an extension educator in ag business management with the University of Minnesota. And I'm coming to you today from my from the basement of my home, but nonetheless, we will be able to do the webinar here today. But welcome to this year's tax update for Minnesota producers. This is something I've been doing for a number of years. Always try to do a fall tax update for farmers at the end of the year, just so they get some of that information at the end of the year. But with that, I think we'll be running about an hour and a half, maybe a little shorter, maybe a little, probably maybe just a little short of an hour and a half. But sit back and we've got a lot of material to cover. The uh, in the chat, folks, in the chat that's posted out on if you look at the bottom of your screen, you should have a chat box. In the chat box, I did put this link, and if you want to copy and paste that link is going to take you to a Google Drive, and that Google Drive, it's going to give you access to a PDF of the presentation today. So if you want a PDF of that, go ahead and go. You can go ahead and download that. Also, I'm going to have my contact information on here. If you rather just shoot me an email, I can email it to you after the webinar is done. So either one will work. Now, uh, moving on here is okay. This is a kind of my standard disclaimer for information. Now, if I really wanted to be legal about this, I would be saying, this is effective, this is information effective today, and I'm not going to get into that. Just for producers out here on the call, I show this slide at producer tax schools. I show this slide at farm estate transfer workshops. I show this slide pretty much anything that I'm doing for producers. Be a good consumer of professional services. All right. When it comes to tax stuff, I really think folks that try to do their own farm return are really doing themselves a disservice. I have, maybe in the 30 years I've been doing this, I have probably picked up two or three returns that were self-prepared that weren't laced with mistakes. All right. And I think the two that I did pick up that weren't, I was kind of coaching them a little bit as they were putting that stuff together. So uh, whether you're doing tax stuff, whether you're doing uh business entities and structures, consult your professionals. All right. Utilize those professionals. It's just good business. All right, source acknowledgments. All right, areas where we're pulling stuff from today. Uh, Minnesota is a member of the Land Grant University Tax Education Foundation. That's a 30 state group that puts together our tax materials for our income tax short course and our ag tax course. And also, I'm pulling some stuff from the IRS website. An additional source that I'm going to cite as well is the ruraltax.org site. Now, I also happen to be a member of that group. Now, ruraltax.org is made up of the National Extension Income Tax Committee. And also, we're also known collectively as the Publication 225 Committee. We always review the Farmer's Tax Guide every year, put out by IRS, and every May we go to DC. We meet with IRS. We give input on the contents of Publication 225, and while we're there, we meet with congressional and various committees, and we do a lot of things advocating for agriculture. So, but that is a free website, has a lot of good information. In fact, you're going to find some stuff that I wrote on it if you check that out. But here's my contact information. Again, I'm officed out of Marshall. The folks, this time of year, I strongly recommend that if you're going to reach out to me, email is by far the best way to get a hold of me. because I do a lot of speaking, I do a lot of traveling. Email's going to catch up with me everywhere I go. If you try to call, you're probably going to initiate phone tag is what's going to end up happening. So I would encourage you start a conversation with email. The agenda, what we're going to talk about today, this is an ambitious set of things to talk about, and these aren't necessarily going to be all in order. I did a little reordering right before I posted this uh, before lunch, and but what we want to do is there's a few select items from the big beautiful bill. That was the big tax reform bill that was signed back in the 4th of July last summer. There's certain things that are going to affect agriculture. We're gonna touch on a few of those things. Tax rates, which also kind of falls under the first bullet. Uh, One of the other issues is the land sale deferral that was part of HR one. And by the way, if I mention HR one and One Big Beautiful Bill Act are one and the same. All right. So if you hear me say HR one, that's just an easier way of saying OBBA, which is the abbreviation for that. But there's a provision in HR one for land sales deferrals. We're going to touch on that. Look at estate tax updates, things that changed with the new legislation. Touch on some new deductions, depreciation update. Give you a quick update on what's happening with BOI reporting. And I do want to spend a little bit of time talking about soil fertility. My phone has been ringing off the hook with people that have been inundated with these residual fertility deductions, and I've got a few slides to talk about that. And then I want to wrap this thing up. Traditionally, I always put together a tax planning scenario and show you some charts and kind of review how the tax rates work and everything, and some things to bear in mind with fall tax planning. So, without any further ado, let's go on ahead and get into this. So, the OBBA, or One Big Beautiful Bill Act, OBBA, I'm also going to refer to it as HR one, like I mentioned. This was signed into law on Independence Day last summer. All right. And just, this is some material from our ag tax book that we discussed that quite extensively this last fall. There's $12.9 trillion worth of tax legislation in that bill. All right. It's huge. I mean, it is just, it's the only way to put it. Now, the only thing that does concern me about this is it does add, Congressional Budget Office, is indicating it's going to add quite a bit of money to the debt. All right, that is an ongoing concern. This is coming from the economist side of me. I kind of tend to be in that camp that's starting to ring that concern bell a little bit, because uh, folks, our national debt now exceeds GDP. And a lot of folks in my circles think that, that might kind of be the tipping point there. So, that is an ongoing concern, but that's not what we're here to talk about. But largely what the Big Beautiful Bill does is it took the provisions of the Tax Cuts and Jobs Act, which was passed back in 2017, and it extends a lot of those provisions that were set to expire at the end of this year. All right, and we'll get more into that coming on down the road. Now, on more things, here's a couple things, and this is one reason why you might want to download the PowerPoint, because these links will be live in that PDF. There's two summaries that I would steer you towards. I owe everybody an apology. I have not had a chance to get our own website updated on all this HR1 stuff. I've pretty much been inundated with tax courses and other projects. But two summaries that I would steer you towards if you're wanting some really good summaries on HR1. Center for Ag Law and Taxation. That's from Iowa State. Christine Tigran is the director there. Christine works with us on Laguda stuff. She's the editor for our ag book. I mean, anything she does, I trust implicitly. But she wrote up a really detailed summary of HR1, and that's available on their website. It's all federal stuff. I would encourage you, if you're looking for resources on HR1, check that out. The second one is from a summary from ruraltax.org. Now, I wasn't an author on this, but I was the main reviewer. So this was authored by Adam Kantrovich from Clemson. This was written while we were at a meeting out in Utah last summer, but it's posted on the ruraltax.org site. And again, stand by either one of those resources. Feel free to do, and they're free, folks. Okay, so let's get into some provisions on this. Moving forward with this. Now, one of the things that HR1 did is it did, it basically set the increased standard deduction and it made it permanent. All right, because if you might not have noticed, but back when they passed the Tax Cuts and Jobs Act back in 2017, it did away with the personal exemptions, and it doubled the standard deduction. All right, and that was set to go back to the 2017, the pre-Tax Cuts and Jobs Act uh, numbers. So it made that increased standard deduction permanent. All right. Now, one of the problems with that increased standard deduction is it makes it harder for folks to itemize. All right. So that's one consideration down the road. It does make it harder to itemize because you have to have more money in order to be able to itemize. So but that was made permanent. I've got another slide that contrasts that a little bit here just coming up. Personal exemption. The other thing that HR1 did is it permanently repealed those personal exemptions. All right, so they're off the books. And one thing to note, when someone says that this is a permanent provision, it just means that it's not scheduled to sunset. All right. Congress could come back next year or the year after and change this stuff. I mean, permanency is only as long as until Congress decides they want to change it. So, but that just means it's not set to expire, is all it is. So, looking at this, the parts that were made permanent when we came into 2025, these were our standard deduction amounts that were coming in. So like for a married filing joint return, we were set to be at $30,000 for 2025. Once they did HR1, there were some enhancements to that. So standard deduction uh, for 2025 now for married filing joint is 31.5. All right, so that did increase with the passage of that new legislation. Uh, Miscellaneous itemized deductions. Uh, New legislation had permanently eliminated all the miscellaneous itemized deductions subject to the 2% floor. All right, now that would include things like unreimbursed employee expenses, hobby expenses, and investment fees. All right, for the farmers of the group, just note that that's something you're going to need to talk to your accountant about when you when you do that. And we don't want to get too deep in the weeds on that one right now. But the other thing that added that it is going to affect a lot of folks, I'm 1 year out from that, but there's a new temporary deduction for seniors. All right, and this is something that does take effect this year, but it's temporary. It only runs for tax years 2025 through 2028. Now, what it amounts to is everybody that's over 65 gets a $6,000 deduction. All right, on top of everything else. So once for instance, if we were to fast forward to next year, okay, I'll be turning 65 in 2026. So when I file my 2026 return, I'm going to be able to, when we file I have file a joint return with my spouse. My spouse is younger than I am. So, I'll get to claim my $6,000 deduction on next year's return, and my wife will have to wait till she turns 65 to claim hers. But it's 6,000 for each person that's over 65. If you're filing this on a joint return, it does need to be filed as a joint return. All right. There are phase outs. If you make enough money, you lose the deductibility of this as it moves on. But this was something that was completely new in HR one. Child tax credit. The thing that happened with the child tax credit is the child tax credit was made permanent per the changes that came from the Tax Cuts and Jobs Act. If we go back to pre 2017, we only had $1,000 child tax credit. All right, Tax Cuts and Jobs Act bumped that, essentially doubled it. And well, that what it did now is HR one, rather than letting it go back to pre-Tax Cuts and Jobs Act, it made that amount permanent. So we're at 2,200 bucks per kid for 2025, and that's going to be indexed for inflation moving forward, right? The act and you see here highlighted here, there's phase outs for this. Above certain levels, you lose that ability to take that child tax credit. The A portion of the child tax credit is refundable. Now, what that means is that you can get the child tax credit as a refund, even though you don't have enough money to absorb it. Now that amount turns out to be, $1,700 for this year. All right, so there's a portion of that that is refundable, and that just simply means that you get that amount of a refund, even though you didn't have enough money to absorb the credit. And they also made permanent for if you have dependents that happen to be 17 years or older, uh, and because the child tax credit has to be kids under 17 in order for that to work. So if you happen to have for instance, a college student that's a dependent that's still living at home, well, and you're providing over half the support, and you claim them as a dependent, you can claim that $500 credit on them. All right. So and primarily what that's geared towards is probably that kid that's in college that's still living at home, and you're providing over half their support. The next topic here, QBI, qualified business income. Now this was that 20% deduction that came out in as a result of the Tax Cuts and Jobs Act back in 2017. Now that provision is made permanent. All right, it was set to expire at the end of this year, and that's now a permanent provision. It also includes the Section 199 Cap A small g, which is the pass through that co-ops can do. All right, it long time ago it used to be called DPAD, Domestic Production Activities Deduction. Now it's it's a QBI pass through. That's the number that gets put in it gets reported on a box labeled 199 Cap A small g on your 1099 Patra that comes from the co-op. But that's a pass through that you can just take as a deduction on your return. They did increase the phase out numbers for QBI, because what that amounts to is if you are if you got income above a certain level, you have to have basis and assets or wages paid in order to claim a QBI deduction. All right, but that's only above the phase out lines. Also, there's this thing called an SSTB. The SSTB is your special service businesses, not really applicable to agriculture, but there's certain businesses that once if you're an SSTB, if you go above the threshold, there's no QBI deduction, period. Let's see. And now next year, this is something for next year. I'm just going to mention it so that so the folks weren't asking about this, because there's been some confusion. The one thing that you have to be careful of with HR one is the fact that some of this stuff is effective for 2025. Some stuff doesn't take effect till 2026, and some stuff is permanent, some stuff is temporary. So it's kind of sometimes it's kind of makes your head hurt trying to figure out what's what. But starting next year, there's going to be a minimum $400 QBI deduction for folks that have at least $1,000 of active qualified business income. All right, this was thrown in there for the very small businesses that might not qualify for a larger QBI deduction. There's a minimum QBI deduction, and it has to be for a trade or business, and they have to materially participate in it. All right, but again, this is not an issue until 2026. So if somebody says, "Oh, you got this $400 deduction for 25," no, it doesn't come into effect until 2026. All right. Here's another thing that we need to talk about. This is very important. Uh, HR 1 put in place a deduction for qualified overtime compensation. Now, uh, simply what this means, folks, is qualified. First of all, we need to define what qualified overtime is. Qualified overtime is overtime that is sanctioned by the Fair Labor Standards Act. The problem agriculture has is, as most of you are going to be aware, agriculture at the federal level has an exemption for having to pay overtime at the federal level. Now, in the state of Minnesota, we are required to pay overtime, but that's sanctioned by the state, and it's different. All right, this has to be sanctioned by the federal. So, in other words, I'm going to jump to the punchline on this. Agricultural production labor is exempt from this. There is no deduction for ag overtime that's paid to your farm workers. All right. So if you have employees and they're earning overtime, they're not going to get a deduction if it's agricultural labor. Agricultural labor means it's somebody that's working on an operation involved in production agriculture. Now, say for instance somebody that maybe works at a meat packing plant. Well, that's ag processing, but it's not production. All right. So if somebody's working at a meat packing plant and they earn overtime, that's certainly going to be qualified overtime. But overtime on the farming operation, you got a client that's a dairy operator and they're paying overtime to their workers. They're not going to be eligible for this. Just period. I don't think it was the congressional intent of this. I think it was an oversight, and is it going to get corrected? I don't know. I don't know, but this was, in my opinion, this was an oversight on this case. Okay, we already talked about this. The Fair Labor Standards Act, it exempts ag from this particular practice. Now, what does qualify for this? If we got folks out there that have non-farm labor that they're going to be working with, and I know I've got some tax professionals on here. The part of this that counts is the actual overtime. Right. So, I know you're not going to hire anybody for $10. Just go with me. The numbers are easy this way. All right. If you got somebody that was making $10 an hour, you're never going to hire anybody for $10 an hour right now, but I know that. But if they're making $10 an hour and the overtime kicks in, well, then you're getting time and a half. So, for the overtime hours, they're going to be getting 15 an hour. It's the $5 extra that they're getting paid. That's the qualified overtime. It's not the total wage. It's just that overtime sliver of the pie that they earn for that. That's what's going to be qualified overtime. All right. Now on the returns, okay, we've already talked about that. So as far as and this slide kind of more or less looks at that if you've got that. So, as far as the overtime go, it's the extra half time that gets added on during that overtime for non-agricultural labor that's going to count. Now, the other part of this that's rather contentious about this is the reporting, because we really haven't gotten a lot of guidance on this. The IRS has stated that employers need to communicate this to their employees. But folks, there's no box on the W-2. There's also no uniform code to use for box 14 for reporting this overtime. So what do we do? My hope is that we're going to get some guidance down the road here. I don't know if that's going to come before filing season or not. IRS is well aware that this is an issue, but in the short run, what I've seen from some material that IRS put out is they were saying that employers just need to show due diligence in reporting this. Uh, I think to put an informational note in box 14 on the W-2, I think is going to be adequate. The problem is that the IRS computer isn't going to be able to pick that up. That's, if they were to issue a code for that, that would simplify things a lot, but they have not done so. Another way to do that would be just to run a final pay stub and give that to the employee, and if that final pay stub shows that amount of overtime, and maybe attach a memo to that, that according to the latest IRS stuff that I've seen would also be adequate with that. So the W-2 reporting on this for the non-ag labor is still kind of a little bit up in the air. I wish I could shed more light on it, but that's what we know right now. All right. Are we going to get additional guidance on it? I certainly hope so. I certainly hope so. All right. So that's what we know about that. One quick thing here on BOI, beneficial ownership reporting. This is the only slide I've got on this because since the new administration came in, this was per executive order. Um, the FinCEN is the group that was administering these beneficial ownership reports, and we talked about these things for I don't know how many workshops I did on these things last year. But but essentially, any type of an entity that you had out there, anything that you went to the Secretary of State for a charter for, you needed a report. And that included actually most nonprofits. I'm treasurer of our Ag Agents Association, of all the extension ag agents at the University of Minnesota, and last year I filed a BOI report for it because we're a 501(c)(5) and we're not exempt. 501(c)(3)s were, but the 501(c)(5)s were not. So I filed one last year. According to this rule, domestic filers, folks that were required to file this thing, but are domestic companies, are no longer required to file. All right, foreign entities with foreign ownership are still required to file these FinCEN reports. All right, and that's the long and the short of it. Now, this is not a change in law. It's a change, it's a change in regulations at FinCEN, but it was done through executive order. All right, so it's on the books. I feel very good. I did not file a BOI report this year for our Ag Agents Association, and I'm sleeping just fine. All right, so I think we're good. As long as you don't have that foreign ownership, I think we're good to go. Okay, one other thing that we want to talk about here a little bit is one of the other provisions that we have is there's a deferral provision for the sale of qualified farmland. All right, and this was also an HR1 piece. So what this provision allows us to do is it allows us to take a sale of a farmland. All right, and what's going to happen? And by the way, this is a 2026 issue. All right, well, the language is on the next slide. So this is not a 2025 issue. This is a 2026 issue. But if you got a client that sells farmland in 2026, they're going to have the option of calculating the sale amount, sale minus basis, calculate the tax, and what they're going to be able to do is they'll have the option. They can pay the entire tax bill in 2026 on the 2026 return, I should say, or they can spread it out over 4 years. Pay a quarter of it one year, quarter of it the next year, quarter of it the next year. You get the idea. So it is not an installment sale. All right. I want to say that again. It is not an installment sale. The total tax is going to get calculated on the 2026 return if that's when the sale occurs. All right. All we're doing is we're deferring the tax paid over a 4 year period of time. All right. So it is not an installment sale. The you know the there's a lot of provisions to this that we need to watch for. Okay, the land that is sold needed to have been farmed for the last 10 years. All right, so it needs to be, it can't be newly developed land. It needs to be land that's been in production. It could have been leased to a qualified farmer, or it could have been operated by a farmer. There's also the other hoops that we have to jump through. This thing has a lot of fiery hoops to it. The you know the when this sale occurs, if the seller is going to do this deferral, they need to have some covenants signed. Now, since this is a 2026 issue, I don't have copies of covenants and everything. I'm sure there's going to be a lot of additional guidance coming out on this before the end of next year. But there needs to be covenants signed showing that land is going to continue to be operated as a farm in a farming operation for the next 10 years, all right, after the date of sale or exchange. Now, if that and that covenant contract, whatever we want to call it, uh, also needs to be included with the first tax return. All right. Now we don't know what that's going to look like right now either. But again, this is a 2026 issue. Now, the provisions are in effect for this tax years beginning after July 4th, 2025. All right. So that's the first available first year is January 1st, 2026. All right. So that's why I say this is a 2026 issue. Now, what I've read on this, in addition to what I've shared with you, is if the covenants get violated, uh, all the guidance says is that it accelerates the payments. Now, folks are going to say, well, does that mean it goes back to the first year? Does it get reported in the year that the covenant gets done away with? Folks, I don't know. That's some of the additional guidance that's going to need to come out on this thing. There's a lot of details that we still don't know about it, but again, this is a 2026 issue. This isn't even in play until we get into next year. All right. So that's what we've got with that. Next, let's talk a little bit about estate and gift tax. So on the estate and gift tax, major changes to the federal estate and gift tax exemptions on this. Now, right now for 2025, our federal estate tax and gift exemption is a 13.99 million. All right. The next year, this is going to go to 15 million. In 2026, the federal gift tax exemption goes to 15 million, and it did make that permanent. All right. So that is a permanent index for inflation moving forward. All right. And on the chart, if you see there's it kind of shows where we've been since 1997. All right, so that number has continually crept up, but there's been a lot of inflation going on to land too. I mean, we didn't have $15,000 acre land back in 97 either. But now does not affect state. I mean, the state essentially hasn't changed at all. I mean, we're still essentially at 3 and 5. Five if you got qualified farm property or qualified business property, and that's a whole nother topic. I mean, check if you've got questions on that, I'd steer you towards the Mendor site, Minnesota Department of Revenue. So, but federally, this is both for that exemption for this gift and estate tax. Now, one quick editorial thing on this. I think this is both a good and a bad thing. The thing that I get squeamish about when these numbers get pumped up like this is a lot of times I've seen, producers will get complacent with this and they think, well, we don't have anything to worry about on the estate tax side of things anymore, so we're just not going to think about it. Folks, on estate planning, all right, University Extension does workshops on farm estate transfer. I haven't taught any of those for a couple, well, one year, I guess last winter I didn't, the year before I did. The you know, there's two pieces to the estate plan. There's, the tax side of things, and then there's the succession plan. Folks, the succession plan is much, much more important. All right. And what I've noticed over my career is it's the tax issue that brings mom and dad to the table to talk about this. Without the tax thing there, I'm fearful that folks won't worry about the succession plan, and that can have disastrous results. Now, that's one of the few soapbox things that you're going to hear me talk about. But uh, as far as this exemption goes, you can't hardly see the sliver on here. I mean, essentially, this is going to eliminate most federal requirements for filing estates. All right, it's just going to be a very minuscule amount. This is coming out of ERS, out of DC. Now, portability is still there. That's also part of that. Now, remember, portability is the ability uh, if we have unused exemption amount from a deceased spouse, it can get transferred to the surviving spouse. We just got a time frame, and we got to do that within, with extensions and everything. We got to do that within 5 years. I suggest getting it done as soon as possible so it doesn't get forgotten about. But that portability is a very powerful tool on that. Now, uh, shift gears to another topic. I didn't list this on the flyer, but this is also important. Now, HR1 did increase our filing requirements for 1099s. All right. Because folks, 1099 miss and 1099 miscellaneous and 1099 NEC. Well, the NEC hasn't been around all that long, but the miscellaneous and that $600 amount's been around as long as I can remember. I mean, it was that way back in 1990 and before. So it's been decades at that number. Now that number doesn't change until 2026. So our threshold in 2026, the $600 threshold for 1099s is moving to 2,000 in 2026. Don't let somebody confuse that. You still got a $600 amount that you have to contend with for 25. All right. I don't want anybody leaving this thinking, oh, we're off the hook now for a lot of 1099s. No, that's not the case. All right. Still got that $600 limit for this year. Okay. Got some depreciation updates that we're going to work on here. Specifically, let's talk a little bit on 179. Now, with Section 179 now, as I'm sure everybody on here is aware, 179, that's an accelerated depreciation method that we can use on certain property. All right, and that property, our farm property that's depreciable, it's all set by class life. All right. For instance, like swine breeding stock is 3-year property, and it progresses all the way up. Machinery could be 5 or 7, depending on whether it's new or used. Single purpose ag structures are 10, drainage tile is 15, and general purpose farm buildings are 20. Now, what we can do is, you look at this. 179 essentially works for 3 through 15 year property. All right. When you look at the depreciation chart, and we can do 179 on any of those assets in those categories. All right. Now our limit, the the maximum amount for last year before HR1, we were scheduled to be 1.25 million with a 3.13 million dollar investment limit. Well, HR1 bumped that quite a bit. All right, so for 2025, we are at 2.5 million with a $4 million investment limit. Now, what that means, folks, is if I bought $2.5 million worth of qualifying 179 property, I can take 179 up to $2.5 million on whatever items that I choose to take 179 for. The limit kicks in. Well, the for the actual amount that I'm taking, I'm limited to 2.5 million. All right. Once that purchased amount, the qualifying property, when you add that all up, if I go above 4 million, once I go above 4 million, it's a dollar for dollar reduction of the 2.5 million. So if you got a client that bought $6.5 million worth of qualifying 179 property, they're not going to be eligible for any 179 because they went 2.5 million over the limit, and it's a dollar for dollar reduction. So once they get to 6.5, they're pretty much done. All right. And this is effective for any tax year starting after 2024. All right. And these amounts are permanent. They're going to be indexed for inflation, which means it'll stay this way until they decide to change it again. Bonus. All right. Also sometimes known as additional first year depreciation. All right. Now, this one is a little more, complicated. They did make bonus depreciation permanent with the passage of HR1, but holy smokes, there's a lot of there's a lot of twists and turns with how they did it. Now, the they put this deadline in here, and I'm trying to find a nice way to say this. All right, assets that were purchased before January 20th are not eligible for the 100% bonus depreciation. Those assets are eligible for 40 because coming into 2025, we were going to be at 40% bonus depreciation. So for that first 19 days, if you happen to buy a piece of machinery and you want to take bonus on it, you can, but you're only going to get 40% on that. Folks, inauguration day was January 20th, and that's what this is all about. I mean, it's 100% political, and that's all I'm going to say. But stuff that was bought January 20th and later, you've got more options with that. All right. Again, let me hit this again. For stuff that was bought January 20th and later, we can take 100% bonus. We also have the option of doing 40% bonus, or we can completely elect out by class life like we've always been able to do. All right. So we got several options. The 60% bonus for this year is probably not really relevant for agriculture. That's largely it's longer production period items like aircraft and stuff like that. It's really not an agricultural thing. I mention it just so that I'm not leaving it out. But what I think for the tax professionals online here, I think what this is going to look like, we're still gonna have to elect out by class life, and that's the way we do this, folks. So for everybody's knowledge, when you get to the 4562, which is the form the depreciation gets calculated on, you have all your assets listed, and the tax return assumes that you're going to take bonus on everything. All right. If you don't want to take it, you've got to click the boxes to elect out. Like if I don't want to take it on my 3-year property, my 5-year property, my 7-year property, I can click and I can elect out on that. I may only want to take it on my 7 and 10, for instance. But you can pick and choose on that. But once you go through the electing out process, then we have to address if you got any equipment that was bought prior to January 20th, well, that's only going to be subject to 40. And then for the stuff January 20th and after, all right, we're going to have to decide, all right, we're either going to do 100 or we're going to do 40 on all that stuff. So the 4562 is going to get really complicated with a lot of check boxes this year. But the good part is it gives us more flexibility. All right, not as much flexibility as 179, but it does give us additional flexibility with that. So it is complicated, but we're going to make it. Now, I do want to take a few moments and talk a little bit about residual fertilizer. This is something that has, in my opinion, kind of got completely out of hand, but I think we need to talk about it a little bit. Now, the whole idea of this, there are promoters. In other words, there are companies out there that will solicit. They'll go to the courthouse and they'll look for land transactions. That's public information. All right. They'll go to the courthouse, they'll find out who bought land, and then that's who gets the letters. All right. What they are alleging is they're saying that if I bought a piece of property, when I bought the property, they're going to work with me on getting some soil tests done, and they're going to write a report, and they're going to come up with a report that says I have all this excess fertilizer in the ground that at the time that I bought it, and I should be able to deduct that like I would purchase fertilizer. Now, there's a number of problems with that. The uh, the promoters on this are getting paid quite nicely. All right, they're incentivized to try and enhance these reports as much as possible. Now, several of the folks on the call here today, I've already had conversations with on the phone, or we've exchanged emails about this. The promoters have backed off somewhat in the last few years on the really ridiculously large deductions that they were promoting. I can remember, within the last 5 years, there were documented stories in southern Minnesota, northern Iowa, where farmers were being told to deduct. They could deduct six, seven, $8,000 per acre of excess fertility upon the purchase of this ground, which is absolutely absurd. Now, lately, we've been seeing a lot of promotional material saying that the average deduction is going to be somewhere around $2,000 an acre. Now, folks, let's think about this a little bit. Uh, Last year, the average fertilizer expenditure per the FinBin database in Minnesota was $180 an acre. Now, that's including nitrogen, phosphorus, and potassium, NP and K. Now, nitrogen is gone in a year. Nitrogen doesn't even come into this calculation at all. We're mainly talking about P and K, and also some micronutrients that are in the soil. Now, if if we have no nitrogen in there out of this $180 that of fertilizer that we're putting on, and they're saying that we can deduct 2,000, or even sometimes I've heard 2,500 an acre. All right, they're telling us that there's over 10 years worth of residual fertilizer left in the soil uh, that's unused. Now, folks, that just doesn't make sense to me or most anybody else. Now, farmers do regular soil tests. If they had that much excess fertility in there, they would be adjusting their fertilizer applications. All right, it's just that simple. So the logic just doesn't work on this at all. Now, the other issue that I have is the only guidance that we have. Well, there's two pieces of guidance. We got Code Section 180, and I would encourage you if you get one of these things landing in your lap, just pull up Code Section 180 sometime. It's only a couple paragraphs. It's short. I mean, it essentially says if you buy fertilizer, you can deduct it. That's it. All right. Uh, Mike, the and that's without question. Now, this TAM, this technical advice memorandum that's out there, this is from 1992. This is really about the only piece of guidance that we've got for these transactions. And this all this is saying is in the TAM, the person taking the deduction needs to establish the present extent of the fertilizer. They need to show the fertility levels. They need to show that the fertility levels were put there by the prior owner, and they need to provide a basis to measure that increased fertility against other land. And also, they need to provide evidence that the residual fertility is going down. Now, that's the one that everybody is failing right now. Nobody is doing that. All right, there, the promoter comes out with this report, says, "Oh, you got all this excess fertility deducted on Schedule F." And is anything going to change with the fertilizer applications? Of course not. Of course not. So I don't believe the scientific method that's being used to calculate this. All right. I think because the promoter is motivated financially to show as much fertility as they possibly can. And I just don't think it's valid. Now, the discussion points on this, the requirements under the TAM, I think that is the best guidance that we have on this. Uh, and I don't think anybody is looking at this. All right. No, nobody is looking at this. Revenue in the past has aggressively audited this issue. Uh, the two more quick points on this. The only scenario that I've really found that I think is bulletproof on this thing is if you've got a land transaction and the seller and the buyer agree that there is excess fertility in that ground and it's included in the sales agreement. Nobody's doing that. All right. But that way, the seller is going to get ordinary treatment on that fertilizer. Then there's, the buyer is golden as far as taking a deduction for that under those circumstances, but that's not going on. All right. These are after the fact, getting these so-called reports. Now, the other things that are happening here that you got to guard against. The promoters are also pushing this deduction on inherited land. And folks, I don't see how that can possibly work because Code Section 180 says it's got to be purchased. So that shouldn't fly anywhere at all. Inherited land is a big red circle with the slash. The other thing that the promoters are pushing is they're looking at old transactions where the tax returns are we're no longer current on those tax years. And what they're saying, well, you can go back maybe 10, 15 years and file a 3115 and claim this backlog deduction. And I think that's a train wreck as well. All right, but I ran into one of those. I did a thing last year for the North Dakota CPA Society, and that was talked about quite a bit. And I had people slapping reports on the table in front of me for to look at, and yeah, I mean, I saw a transaction from 2010, and the promoter was telling the farmer they could deduct $1.2 million on that thing and file a 3115, which is a change of accounting method. Not a good idea. Uh, Folks, here's another resource I'm going to steer you towards. If you have well, first of all, for the farmers that are considering this deduction, here's an article. It's a link to an article from Center for Ag Law and Taxation. Christine Tigran wrote this. It's an article on considering the soil fertility deduction. I was a reviewer on the article. I completely agree and endorse the contents of it. It goes through an analysis of IRS code, regulations, and case law. and it essentially concludes this is not a valid deduction. I encourage you to take a peek at that. It's posted on the call website. I'd encourage you to look at that thing. If you got a client that is considering this, send them a copy of the article. All right. I wouldn't touch this I wouldn't touch these, period. On a final note, folks, I have had several conversations with IRS criminal investigation staff this year, and they are very interested in this. Now, IRS doesn't have the most resources in the world right now, but folks, I'm telling you, this is on IRS's radar, and when trouble comes, it's not going to be pretty. And that I'm just going to stop with that on that. Uh, One other item that we want to touch on here real quickly is I still, we've been doing tax schools all this week, and I've had a lot of interaction with folks online, and apparently the research and development credit promoters are still out there as well. Now, I will call these guys out by name. Alliant Group is the one that's primarily doing a lot of this stuff. They're based out of Texas, and what they're doing, folks, is they are approaching farmers. In fact, I don't know if they're going door to door. In Illinois, they were actually going door to door and promoting stuff. But I know I've had calls from Rochester and calls from a number of the farm business management instructors around the state. But what they're doing is the promoter contacts the farmer, and what they're telling them is that if you're using like GPS technology, like if you're using auto steer and you're using GPS technology for variable rate planning, that you qualify for research and development credit, and folks, that is absurd. The research and development credit is designed for folks. If the farmer is participating in research trials or is part of some kind of research project, just using GPS technology in the farm does not qualify for an R&D credit. Uh, the folks that are pushing this are based out of Texas. IRS rated them FBI rated them a couple years ago for doing fraudulent ERC claims. And so they quit doing those, and now they're doing this. That was in the paper. I'm not going to get sued over saying that. So, just be aware of that. I would stay away from that. Wholeheartedly stay away from that. So, next thing, tax planning. All right, I've got some stuff that I'm going to run through here real quickly on the tax planning side of things. And now I intentionally did not put up some charts, but net farm income over the last 20 years has really kind of been up and down. We've had three periods of really high income from an accrual adjusted standpoint, and most farmers are cash basis filers, so they're not going to pay tax. If they had a year where they had close to $400,000 worth of accrual adjusted net farm income, they're they're going to prepay expenses. They're going to defer income. They're going to go buy some shiny paint and write it off, and they're going to defer that tax is what they're going to do. So, but what happens when that occurs is that you got this deferred tax bill that's kind of rolling forward. Well, now we've had two really low income years, and I don't think 2025 is going to be any better. We still have not such hot commodity prices and everything. So our challenge this year is probably going to be to try and balance out any deferred tax liability that we have rolling forward. But we also have to be cognizant of the fact that, the banker might not go along with spending a bunch of money when we're probably already looking at a loss on the tax return. So we're going to talk about a couple things here. If we have a low income year, and I always encourage folks, you want if there's any way to get enough money on that return to burn up that standard deduction, you want at least that much on there. All right. Because if you don't use that, it's gone forever. All right. So that's just good money management. You might have to accelerate some sales if need be. Postpone expenses.
don't write stuff off with 179 in bonus. Now, another thing that we can do is on the fertilizer expense. If you're trying to reduce expense, we do have the ability to amortize a current fertilizer expenditure. So if you got somebody that's in a loss situation, rather than expensing the entire fertilizer expense, might be able to spread it out over 3 or 5 years. Now, folks are going to ask me, well, how many years then? It depends on your soil type. I think heavy soils, I'd probably do like a 5 year, and maybe if you got a lot of sandy stuff, maybe it's going to be like maybe three. Go with a shorter year in in a sandy light soil. But all you can do is you can just amortize that out over several years, decreases the expense in the current year. And it's an election that you can make every single year. So you could do that this year. You can go back to the normal method the next year if you so choose. So the other thing that we can do is we can do capitalized repairs. All right. Now, this is an option that is out there under the tangible property regulations. Now, what that allows us to do is we can pick and choose if we got some major expenditures, like for instance, if I had some repairs, for instance, well, let's say for instance I took the combine in after harvest, and they end up doing belts, hoses, bearings, the end of the year. We ended up doing the end of the year maintenance type of stuff, which can get into quite a bit of money. Uh, you know, Under the repair regulations, we can take that as a repair because it's under the maintenance safe harbor, right? If that qualifies, we can choose to capitalize that repair and stick it on depreciation schedule and spread that out over time. Now, again, you can pick and choose what you want to do there. Just because you decide to capitalize those repairs doesn't mean you have to capitalize everything. You can kind of pick and choose what you want, but I try to segment it into maybe it's the repairs on the combine, the repairs on the tractor. You need to kind of look at your general ledger under the repair expenditures on that. But that's a definite possibility for that particular item. Now, let's flip let's flip the chart. We always want to talk about the what are we going to do in high income situations. All right. Well, we can prepay expenses. Now, folks, I didn't detail this out. Remember, on the prepaid expenses, uh, if you want the detail on that, consult Farmer's Tax Guide. There's real good details on that in there. I did not want to clutter this up with another 5 slides, but prepaid expenses, you can prepay up to 50% of the Schedule F expenses, including depreciation, and but you can go up to 50%. The main thing that I want to encourage everybody is make sure that it is an actual purchase. You can't just go to the co-op and put money on account. That's not a prepayment. All right. You need to actually, if you go to the co-op, you need to come out with a receipt saying I bought this, this, and this, and that will qualify as a prepayment. All right. If you go over the 50%, you can do that as long as you're a qualified farmer and you haven't gone over in previous years. All right. There's like a 3 year window on that. So there are provisions where you can go over, you get a mulligan if you need it. But my general rule is I try to stick within that 50% rule. I think with the way the economy is right now, I don't think we're going to have too many people pushing that. But second thing is income averaging, and I've got some slides coming up on that. Deferral of income. Now these are like your crop and livestock sales. So, crop insurance can be deferred as long as your cash basis, and you normally would have sold the crop in the following year. Now, we have rules in the Eighth Circuit where it's an all or none type of thing. You need to look at all of your crops, and say if you grow corn and soybeans, you got to make sure that you are selling over half of the corn next year and over half the beans next year. All right, then you're okay to do that crop insurance deferral. Um, The other thing on the deferral is that's not mentioned here is deferred payment contracts. All right, deferred payment contracts are okay under the installment sale rules. Now, if you're doing a deferred payment contract, this is where I would go. For instance, if I were a farmer and I went to the ethanol plant in town and I did a deferred payment contract, what I'm doing is I'm going to do a contract that says I'm gonna bring them corn today, but I'm not going to get paid for it till after the 1st of January. All right, that's a deferred sales contract. You got to have that paperwork in place before the deal is done. All right. And it's got to be a written contract. The accelerated depreciation, 179 and bonus, we already talked about that. And crop insurance deferral, I already hit that as well. So let's talk about a few of these things here that I think are pertinent. Income averaging is by IRS's own admission, this is greatly underused. It's underutilized. Not as many people utilize income averaging that probably should. Now, it only affects farm income and it doesn't affect self-employment or taxable income. All it's doing is it's blending the rates, is all that's happening. Now, let me get my laser pointer going here. So what this chart is, this is a chart I've used for years. Now, the line across here, I could draw a straight line here. The line across here is the top of the 12% bracket. All right. Now, over the last 3 years, these were my income levels, which is there's a gap between the top of the 12% bracket and where we ended up. All right. And let's say, for instance, I've got a lot of income here in 2025. What I can do with income averaging is I can take this money in the 22% bracket and I can put it back into these unused 12% brackets in the prior year. And I can use those unused brackets is what I'm essentially doing. I have to put an equal amount of money back into each year. All right, that's the rule. All right, so if for instance this red part in 25 was $30,000 that I wanted to put back, 10 of it would go here, 10 of it would go here, and 10 of it would go here. All right. And you got to kind of play with that a little bit to see where there's usually a sweet spot in there. But that's it gets filed on Schedule J, and it's not terribly hard to fill out. All right. So if you're not utilizing that, or your tax professional is not using that, that's something to probably push because you might find that is helpful with your filing. Okay. I do have an example here that I want to walk through, and I see we're taking a little more time than I originally thought, but we are for sure going to be done by 4 o'clock. But on this is a chart again. This is a chart that I've used for a number of years, and it's quite simple. Now, this is assuming a self-employed individual. We are largely use this for farms. Now, the blue line here for 2025, and this is for married filing joint. The blue line is our regular tax line. We got a 10% bracket, a 12% bracket, and then we jump to a 22, and then we got a 24 out here, and it would go on for another foot over here, all the way up to the into the 30s. The orange dotted line is our self-employment tax, 15.3% out here to the maximum for the FICA portion of the self-employment tax, and it drops down to the 2.8%, 2.8 Medicare portion, but that goes into infinity. All right. The green line is just adding everything up. So it gives us a pretty good perspective of where we're at from a taxable income standpoint, and it allows us to correlate what that marginal tax rate is going to be. All right. When we combine self-employment and regular tax. So let's apply this thing. All right, we've got client walks in the door, farmer, and we're doing our fall tax planning meeting. They walk in the door and they've got a projected Schedule F of $200,000 net. All right, after taking all the deductions and everything, running it through the software, we come up with taxable income of right at 124,000. All right, so I ran this through my tax estimator, federal tax is going to be 17,000 and change. The self-employment tax is going to be 27,000 and change. Total tax bill 44,283. All right, we're in the 22% bracket. So let me back up here. 124,000. So we're going to be about right here on the chart. We're going to be not quite in the middle of the big green hump, but we're up on the big green hump. So we've got some money that's getting taxed at a pretty high rate, with that current scenario. So what we're going to do in this case to mitigate this, uh, have a talk with the client. The client actually is someone that would prefer to max out in the 12% bracket if at all possible. They just don't want to pay that high priced money as part of the big green hump. So what we do is we do some finagling here, and we decide to do a prepayment of $20,000. We're also going to take some 179 on some equipment that we bought, and but bottom line is we're generating an additional $36,000 of expense that we didn't have before. Reduces the Schedule F to 164,000. And then we're going to be at 96, just about 97,000 for taxable income, and it drops our federal and self-employment tax. We're dropping the total tax bill down to 34,303, but we're down in the 12% bracket as a result. All right. So what changed in this case? So we're going from 124 down to 96. So folks, on the chart, we were going from essentially here down to here. All right. We eliminated that expensive money by doing that prepayment. Now, folks, my philosophy has always been I pay more attention on tax planning to the rates than I do the dollar amount. Now, that's going to depend on the client, of course. But I would rather pay attention to the rates and try and maximize those lower rates, especially if I got somebody that, if we might lower the tax bill and then next year we don't want them way up into the super expensive range. I try to keep everybody as even keeled as I can from year to year. But in summarizing this, what we're looking at here, we spent an additional $36,000 through accelerated depreciation and prepayments. We cut the tax bill by just about $10,000. All right. So we saved the farmer essentially 28 cents on the dollar for everything that they spent in addition, those additional expenses, which is a pretty good return on money when we're talking about tax management. Now, the reason why we're not getting like a 38% reduction on that money that we spend is QBI kind of starts to mess us up there, because our income at a high level, we're getting a QBI deduction. We're getting a 20% QBI deduction at that level, and when we prepay that down as the income comes down, so does the QBI deduction. So that kind of when you got QBI in there, that kind of skewers our savings a little bit. But nonetheless, significant tax savings with that. And again, just looking at this, I mean, what we did in that example, we were going from here 124 down to 97, 98, which is just right underneath the big cliff. All right. So that's my philosophy on that, folks. Take it for what it's worth, but and for the farmers out there, the only other thing to mention is that if the farmer were to prepay and do additional expenses to move that income down to a lower level, you'll see here that going from here to here, there's no reduction in the rate. You're going to lower the tax bill, but when you spend money here, you're not getting as much of a savings as you're getting when you spend money to go from here to here. You're getting a big bang for your buck. To go from here to here, it takes a lot more money to save that dollar of tax. All right. On that note, I've got the chat box open here. You've been a quiet group, but I've got the chat box open here. Any questions out there that anybody may have? I guess we can take a few minutes and we can take a few minutes and address those if at all possible. And while we're at it, I'll put my I will put my contact information up here as well while we're talking here. Uh, while we're waiting for any potential questions, um, yeah, um, we will do a recording of this, and we will get this thing posted in a few days. And with that, folks, I don't see any questions coming in, so I think what we will do is we'll go ahead and adjourn this. And I wish everybody a pleasant evening. And if you do have individual questions, feel free to shoot me an email. I am teaching the rest of the week, so it might be in the next week before I get a hold of anybody. But I'm pretty much teaching all day tomorrow too. But I thank everyone for joining us today, and have a very pleasant evening. Thank you.